The markets have opened and we see some very mixed results straight off the board, although some of the big names like Nvidia, like Tesla are down 2 to 4%. Very interestingly as well, on Friday we heard from the Fed chair, Mr. Powell himself, where he did mention the time has now come for those rate cuts to take place. Now, he didn't in fact provide any exact indications of what the rate cuts would be, how many percentage points and what month. However, what we do now note from the market, the way it is trading, that the expectation by traders as well is that next month we will see the beginning of this, and it will be interesting to see how the market does react when we get that first cut, which is anticipated to be in September. We can also see now in the Fear and Greed Index, we have entered neutral territory. In fact, it wasn't long ago, just last month, where we were sitting in fear, and we can see some of the money that has been sitting on the sidelines has now started to pour into companies. And today our focus is going to be on analyzing 6 undervalued dividend stocks that we believe you should buy the dip. Now we're going to talk about each one in detail, looking at their historical performance. We're going to talk about their dividend safety, some very important underlying financial metrics, and we also want to run through dividend yield theory to give you an analysis on whether or not we get a double and in fact possibly a triple signal that this company is severely undervalued. And as always, we're going to run it through the valuation model. We want to get to our intrinsic value. We want to tell you what our margin of safety is, 10, 15, 20, 25%, as well as the ultimate upside that Wall Street see over the next year. And we'll also mention whether or not we are buying each one of these companies. So the first one is ASML, the semiconductor giant, one of the biggest companies in the industry, where we get in fact a double buy rating, Seeking Alpha and Wall Street. Do note these scores are out of 5, and 4.5 would be a strong buy, so Wall Street isn't that far off, and we do see Quant the only one that gives it a hold rating. Right now, it pretty much sits not far off the midpoint of the 52-week range. It does have a very high forward P of 43.1. We're going to come on to that shortly as well. And we do note, although it does have a fairly trivial yield at 0.73%, this is one of those companies that does grow the dividend historically at a very rapid rate. We also note over the last year, it is up around 35%, although as we said, sitting at the midpoint, so it has come quite some way away from its all-time highs. And over the last 10 years, significantly outperformed the S&P, up 824%. And this doesn't include those dividends reinvested, so if you were reinvesting, it would be marginally higher. Very quickly as well, when we do look at their historical performance, we do note they have beaten management targets over the last 4 quarters, 100% track record. We'd love to see that. And over the next 4 quarters, they are anticipating some very large growth to the EPS year on year. If they do in fact hit that from next year, so December 2025, the forward P will come down to a much more reasonable valuation at 27.1. Now when we talk about this company, dividend safety does sit at 82, so it is very safe, although we do understand the yield isn't the highest. And we do want to point out they just recently increased their dividend last month at 4.8%. Not the greatest, considering we always talk about a minimum 4% just to keep up in line with inflation, and as we are about to show you as well, historically it has been very high. Now, for those that want to know, it was reaffirmed just at the beginning of this month, a very safe score, and what it ultimately means is that a dividend cut is highly unlikely for this company. Now, we're also going to run through some key metrics for each one of those, that how they performed during the last recession, the 07-09 Great Recession, and ASML actually cut their dividend. They had below average growth at negative 56%. Bear in mind, S&P negative 12, but they had pretty much a bang-on S&P return, negative 55, the same as the performance of the S&P 500. Now, as we said, a little bit disappointed with the increase this year, purely on the fact that over the last 5 and the last 10 years for ASML, we have seen some extraordinary growth, and we do also note they have been increasing those dividends for the last 14 years. As we mentioned, dividend yield theory is something we'll look at for each one. It states a company is undervalued when the current yield sits above the 5-year average. So we have our first signal of undervaluation. In fact, a double undervaluation signal, as the forward P 31.9 is below the 5-year 34.2, although we do have to point out that the information technology sector does sit much lower at 26.2. Bear in mind there will be a lot of poor quality companies within this bracket, and as always, we're not looking at any one of these models in isolation. We will conclude towards the end. Now, free cash flow, as always, we will draw your attention to this metric over the earnings, which we do believe to be susceptible to manipulation by management through accounting. We want to see below 60%, although for those that want to be industry specific, below 50. And the main reason we have these percentages is because then it does give us faith management can offer double-digit increases moving forwards, which is really what we want to see as dividend growth investors. Over the last 10 years, it has been below 50%, bar 2023 at 74, which therefore is no surprise as to why we saw that mediocre dividend increase this year. Over the next 12 months, though, down to 14%, so hopefully we can see them bring back those large double-digit increases moving forwards. Free cash flow per share, ultimately, we want to see increases consistently over the longer term. Do bear in mind, this industry as a whole, the semiconductor space, is very, very cyclical, hence why we don't always get that consistency. Although we do see 153 up to 24.20 in 2021, down to 8.25, and over the next 12 months, another massive jump to $20.60. In terms of sales growth for the more mature companies, we want to see steady, moderate growth of 3 to 7%. What we note for ASML, it is a very fast-growing company, nearly double-digit increases to the top line every single year, and from a numerical perspective, we do note it has increased very, very rapidly. In fact, more than 4 times in 2014, around $6 billion, to 28 in 2023. Now, we'll always draw your attention to the shares outstanding. Ideally, we want companies that do share buybacks, returning excess cash to investor pockets, and ultimately it gives you a larger portion of control of the companies. And we can see they do this for ASML very, very minimally and very inconsistently, but as always, a bonus on top of that dividend increase that we have come to love with this company. ROIC, one of our most important metrics, 10% or more, or 12% for semiconductors, give us faith management are able to effectively allocate their capital. Great job, consistently above the minimums and increasing over the longer term. Last 3 years in the mid to upper 40s, very, very strong to see. We always love companies that have incredibly good and very consistent metrics, ROIC being one of them. We then move on to margins above 16%, and not just that, ideally we want to see operating efficiency with margins increasing. We do get that consistency and increases with ASML, 33% in 2023, and in terms of the free cash flow margin, whilst we get a lot of inconsistency on a year-on-year basis, again, cyclicality is something to bear in mind, it has been always above that minimum 5%. We then move on to the net debt to EBITDA, which references the earnings before interest, tax, depreciation, amortization. Below 1.5 is what we want to see. The numbers below refer to the number of years it would take the company to pay off all of their debt net of cash on hand. 0 right across the board, 0 over the next 12 months, means it wouldn't even take them 1 day to pay it all off. Very good balance sheet, very safe dividend, and what we always love about this metric, it correlates to both dividend safety and balance sheet strength, hence why that is why we always refer to this as one of the most important metrics alongside the ROIC. We then jump into the valuation model. As always, if you do enjoy the content, value is being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now, our intrinsic value today of 1152 comes directly from the DCF model, which isn't too far off Wall Street's price forecast of 1173, where they see 33% upside, and this is a very strong company, definitely one that you should consider. Before we jump into the margin of safety, how we got to this intrinsic value, we run it through the DCF model. As you can see here, free cash flow year on year, average growth at 35% over the period. Forward looking, we have gone for 30%. Now, you may believe this being a little bit high, but as we can see, lower than the average growth rate. And in fact, typically we have gone through companies' estimates, and we do have estimates from analysts from Bloomberg who believe the AI industry as a whole will increase around 40 to 50% every single year over the next 10 years. But we've also done a low, medium, and high rate for those that do believe different numbers are more appropriate. At the 30% though, with the discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and we can see here this 1152, which does in fact imply around 23% upside. Now, for transparency, for those that believe that is way too high, well, at 25%, we can in fact see $831, which as noted here is downside of 7%. At the 35% level, we can clearly see here 1584, which ultimately means upside of 44%. Now, whilst we will take 30% to the final slide, do bear in mind these numbers can change, they are subjective, and you can always grab a copy of this model by clicking on the pinned comment below to run your own numbers through, whether it is for ASML or any other company. We then always use a margin of safety on this channel at 10% at a bare minimum, which we execute on if it meets our 3 golden criteria, which is a wide moat, strong financial metrics, and good forward-looking data. Well, if you believe that, it is a buy up to 1037, and then we keep going till it's near the current trading price, 15% around 980, at 20% around 921, and as we can see in today's episode, not quite at the 25% level, at around 20% right now, a buy up to 921. This we do believe to be a no-brainer buy, and if it does hit that 25% margin of safety at around $864, this is one that we will seriously consider in adding to our portfolio. Very good metrics right throughout as well. So a 20% MOS in today's episode with upside of 33% from Wall Street. As always, do give us your thoughts as we go along these stocks today. Also, just to let you know, we have released our latest free weekly article where we run through 3 undervalued dividend stocks. Now, these have some phenomenal growth rates, and we talk a little bit about rate cuts that are coming over the next few months. If you want access to this article or any other articles, you can click on the pinned comment below. They are free and very easy to read, so do go check that out. We have also released 35 undervalued stocks for your consideration for the month of August, and we also talk about those that sit within our own portfolio. We do release these once every month, so again, make sure you are subscribed below. The next stock to consider buying the dip, we have Zoetis, very strong company, again a double buy with a hold from Quant, and this one also not far off from being a strong buy from Wall Street. This is trading in the upper end of the 52-week range. It has a yield just below the 1% level, a forward P around 31, and over the last year, whilst it is down around 3%, over the last 10 years, again, massive outperformance of the S&P, up 413%. We do, however, note all-time highs towards the back end of 2021 around the $250 mark. When we look at its earnings, we can see over the last 2 quarters they have beaten, although quarter 4 they did miss, with quarter 3 being in line. So about a 75% track record of at least being in line or beating targets, with the next 4 quarters, as we can see, looking very healthy in terms of an increase, and with their earnings per share for the end of next year, that forward P does come down to around 28. For those that do want a comparison, the S&P does sit around 23. Now, when we take a look at this company, the dividend safety score does seem to be safe at 74, and a very nice double-digit increase in December last year. Now, in terms of dividend safety, well, a safe score now means a dividend cut is unlikely, and in the last Great Recession, what we do know, they had some very good sales, up 30%. As we mentioned, the S&P at that time was negative 12. We also love the sheer consistency in the growth rates at double digits, with over the last 10 years being 23% year on year. Very, very phenomenal, and it has been increasing those dividends over the last 10. We then move on to dividend yield theory, where we get a double undervaluation signal, both on the yield as well as the forward P, although we do note the healthcare as a whole, sector-wise, sits at 17, which is significantly lower than Zoetis. Then we jump into the payout ratio, where every single year below 60%, so we love to see that. 43 in 2023, 34 over the next 12 months. And in terms of free cash flow per share, pretty good in terms of the consistent growth year on year. And over the next 12 months, it is anticipated to increase from 351 to around 502. These are all good points that you do want to see from metrics when you are considering companies to buy. And over the last 10 years, the sales growth has also been fairly healthy as well. Remember, at a bare minimum, 3 to 7%. In fact, bare minimum, we are talking about 3%, just to keep in line at a minimum at the inflation point. In terms of numericals, though, we can see nearly doubled over the last 10 years, and very similar to ASML, we can note they have been doing some share buybacks over the last 10 years, maybe not as consistently as we like, and fairly trivial. ROIC, though, very, very good. One of the things we like, not just being above the minimum, but consistency throughout. And we do typically say this on the channel. Sometimes having consistency over the longer term is worth paying a little bit of a premium for, or in fact having a smaller margin of safety. We then move on to the margins. Very good to note that it has been increasing over the longer term, so we do like that operating efficiency, and the free cash flows at a minimum above 5% and looking very healthy, especially from 2017, 19% in the more recent year. Then we get to the net debt to EBITDA. We want below 3, and below 3 is exactly what we get. 1.27 in 23, 1.24 over the next 12 months. So very healthy balance sheet. And as we said, dividend also looks to be safe. So what about the valuation? Well, the intrinsic value in today's episode sits at 225, and Wall Street isn't too far off at 218. Their upside is 20%. So when we do put it through the MOS calculator, at 10% a buy at 203, at 15% around 191, and at the 20% mark around 180, which it isn't far off, and we would consider that a very good buy if you do believe in the longevity of this company, you do like the metrics, and you does fit right into your portfolio and your investment thesis. If you can get it at a 25% MOS at the 168, we do believe this is a no-brainer buy, especially if you do like this company, and do let us know below if you want us to do a deeper dive on what we do believe a very strong and consistent stock. We then move on to Intuit with one buy rating from Wall Street and a double hold. This one trades in the mid to upper end of the 52-week range with a yield of 0.67%, a forward P of 32.1, and over the last year up around 20%. Over the last 10 years, again, another significant outperformer of the S&P, up 638%, and we do know all-time high sitting just below $700 in November 2021. Now, in terms of their earnings, well, very good to see a 100% track record over the last 4 quarters. The next quarter, they are anticipating a small drop, but moving forwards over the subsequent 3, double-digit growth, with July 2026, a APS estimate of 22, and a forward P coming down to around 27.98. We then get a very safe dividend score of 98, with just last summer having a 15% dividend growth rate, so we are anticipating one very soon, and would be fairly surprised if we don't get a double-digit rate. And when we look at the last recession, well, in fact, no dividend was paid, something fairly new, so no comparison. A plus 1% recession sales, and they also outperformed the S&P, negative 29, as we said, S&P negative 55. Again, something that isn't as common as maybe you would think, but over the last 5 and the last 10 years, we do know double-digit growth to the dividend, and they have been increasing this over the last 12 years. Then when we move on to dividend yield theory, we get a fairly reasonable valuation on the yield, 0.58, not far off 0.66, and we do also note the forward P is lower than the 5-year average, 32 versus 35, so that is an undervaluation signal, although we do know the information technology as a whole does sit much lower at 26, not something that Intuit has been around that level for quite some time. Then we talk about the free cash flow payout, well, below 60% by quite some margin every single year, so no surprises why it is a very good growth company and one that we do believe and would be very surprised if we don't get a strong dividend over the next few days. We then move on to the free cash flow per share, as consistent as they can come. In fact, nearly 4 times growth into 2024, expected a big jump over the next 12 months, so we can start to see why this company is valued at maybe a higher forward P than others in the industry. And in terms of sales growth, there we have it, double-digit growth every single year, bar 2015, the last 2 coming in at 13%, with the growth rate looking very good, 4 times from $4 billion in 2015 to 16.3 in 2024. Now, over the longer term, they've done both share buybacks as well as share issuances. From 2015, it has barely moved to 2024. Nothing really negative to note, but just something to bear in mind if you are considering this in your investment thesis. And in terms of the ROIC, well, double digit every single year. Good sign, but a little bit inconsistent. It has come down from the highs of 2017. Nonetheless, 15% in 2024 is still very healthy and what we do like to see. And margins looking very, very good, above 12% consistently, 24 in 2024. Free cash flow margin, probably a very strong free cash flow machine, as we can clearly see in the 30s just over the last 8 years. And when we finally bring your attention to the net debt to EBITDA, as good as they really come, below 3 is what we want. Remember that. Nearly 0 right across the board, 0.37 in 24, 0.32 over the next 12 months. So definitely one to consider in your portfolio solely based on these numbers. We then want to jump into the intrinsic value. Today's episode at $734. Pretty much thereabouts Wall Street of 741. They see 20% upside. Again, we do believe this to be a high quality company. And at a 10% MOS level, a buy at 660, at the 15% around 623. So that is what you are getting right now based on the estimates and judgments. 15% margin of safety safety, 20% upside, but for those that are looking at the 20 to 25% level, 587 is a buy at 20%, and for those that want 25, around 550. Now, we do believe, again, 20% margin of safety does make this a very compelling company to add into the portfolio if maybe this is an industry you are lacking. But right now, even at the 15%, it does seem to be healthy. As always, do give us your thoughts below. We then move on to Visa. Now, we do get a double buy and a hold from Quant. This one is trading in the mid to upper end of the 52-week range with a yield of 0.78%, a forward P of 27. Over the last year, well, up 10%, although it is a little bit away from its 52-week high. Over the last 10 years, another significant outperformer of the S&P, up 406%. Now, over the last 4 quarters, well, more recent one from a few weeks ago, it is in line. Previous 3, they did beat. Moving forwards, we do get 3 of the next 4 quarters double-digit EPS growth, with September 2025's EPS estimate bringing that forward P to around 24.2, right there or thereabouts of the S&P. We have our first 99 very safe dividend score, and we do know dividend growth double-digit last October is something always we have come to expect with this phenomenal company. And we do know when looking at the metrics, they did in fact increase it during the Great Recession, plus 9.5% sales as well, so it does look very healthy. And as we mentioned, it is something we have come to love with this company. Every single year, they do always leave a smile on investors' faces with that double-digit increase, which they have been doing for over the last 5 years on a consistent basis. We then get to dividend yield theory, where we get the undervaluation signal on the yield, as well as the forward P that sits at 25, lower than the 5-year of 28.4, although we do know the financials as a whole is much, much lower, but within that, as we always say, there will be a lot of very poor quality companies. So what about the metrics? Well, free cash flow payout sits below 60% every single year, 19 in 23, 21 over the next 12 months. We then move on to the free cash flow per share, which looks very good, more than triple over the last 10 years, expected to increase, although marginally over the next 12. And when we get to the sales growth, it is double digit nearly every single year. We have the COVID drop of negative 5%, but in 2023, 11%, and on a trailing 12-month basis, we still get that 10% double digit consistency from Visa. Now, with the growth in terms of numerics, nearly triple over the last 10 years, but probably what we do also like, on top of the dividend growth from Visa, is that they do consistent share buybacks on a year-on-year basis, and it's gone from around 2.52 to 2.04 in that latest quarterly report. ROIC, again, very, very good, double digit every single year. This company just has some absolutely phenomenal metrics, and that can be shown when looking at the margins. Operating side, it is very high already, 64% in 2014. There is that operating efficiency to 67% over the last few years, and the free cash flow margin, clearly a free cash flow machine. We then bring your attention to the net debt to EBITDA, again, phenomenal, 0.05 in 23, 0.14 over the next 12 months. No worries whatsoever. Now, our intrinsic value of 323, we do note a little bit higher than Wall Street of 315, where they have upside of 18%. And when we do run it through the MOS, well, 10% a buy at 290, at 15% at 275. And in today's episode, it isn't quite at that 20% level, but that is somewhere where we would say it is a very strong buy. This is a high quality company, one that we do believe will be around for a very, very long time. And for those that want to see at 25%, it would be a buy at 242. So for us, around 20%, a very strong buy. Right now, though, you are getting around 15 or 20%, with Wall Street indicating 18% upside over the next year. We then move on to UPS, where we have a double buy rating and a hold from Quant. This one is trading right there towards its 52-week lows. We have a yield of over 5%, so that does make a bit of a change for the previous companies we have just gone through, and a forward P of around 17. Now, over the last year, it has been hammered down around 24%. Over the last 10 years, up around 31%. So the first one today that hasn't outperformed the S&P over the last 10 years. And when we do look at their earnings, well, a fairly substantial miss in the more recent quarter. The previous 3, though, we do note they have beaten. And moving forwards, we are looking at some inconsistent growth. Although over the next few years, we can see the EPS estimate of 9 for December 2025 does lower that forward P to around 14.2. In terms of dividend safety, well, 69, so it does look to be safe, although we are very disappointed in their January this year increase of 0.6%, but it does make sense when you do look at their numbers as well as the metrics. Now, in terms of the last recession, they actually maintained the dividend. They didn't increase it. They didn't cut it. They had average growth, and they also marginally outperformed the S&P. As we said, very disappointing growth this year, although over the last 5 and the last 20 years, we have seen some nice double digits, and they have also been increasing the dividend for the last 14, whilst paying a dividend for the last 55 without a reduction. In terms of dividend yield 3, well, massive undervaluation signal. This is the highest yield they have offered over the last 5 years at 5.05%, and the forward P of 15.7 is marginally lower than the 5-year 16.6, but we do note it is also significantly lower than the industrials as a sector, giving us our first triple undervaluation signal today. In terms of free cash flow payout, well, a bit of a red flag indicator, as we say, below 60%. In fact, over the last year, 110%, which is essentially telling us that this company has paid out more in dividends than they generated in free cash flow. Over the next 12 months, it is lowering to 81, so that is a relief, but don't expect over the next year a massive increase. We would expect hopefully at least a 3 to 4% inflationary rise. We then move on to the free cash flow per share, where it is fairly inconsistent. It has been increasing though over the longer term, and over the next 12 months, it is anticipated to move in the right direction. In terms of sales growth, well, negative 9% in 2023. Do bear in mind they did recently win a contract with the United Postal Services, and although that is fairly marginal, we do hope that will increase their top line. And in terms of numerics, we can in fact see nearly doubled, 58 billion to 91 on a trailing 12-month basis, marginally lower at 89.5. And in terms of the shares outstanding, well, as we say, return excess cash, something they do, although fairly marginal, so don't bank on this when you are looking at your own investment thesis for UPS. In terms of ROIC, well, as we say, above 10%, and what we do note, it has been decreasing over the longer term, but still fairly healthy in 2023 at 20%. A little bit worrying though, on a trailing 12-month basis, that decline has continued, so do factor that in. Maybe a larger MOS level is needed. And when we look at the margins, 12% isn't really what we get on a consistent basis, although it does straddle around that. And on a free cash flow margin basis, we can see the same as well, straddling around the 5% point. Finally, we bring your attention to the net debt to EBITDA. Below 3 is what we want to see. What we get every year, 1.58 in 23, a very marginal decrease over the next 12. So yes, the dividend does still look to be safe, as well as essentially the balance sheet does look to be secure. So our intrinsic value of 147 is a little bit lower than Wall Street's 152 of upside of 19%, and a 10% margin of safety does indicate a buy at 132. It isn't quite at the 15% level of 125, but it isn't far off, and it could be one for serious consideration if you do want a bit more yield than the previous 4 companies we have just run through. For those that are looking at the 20% level, will they buy at $117? But as we said, somewhere between 10 to 15% in today's episode, with 19% from Wall Street and their estimate. We then move on to Alphabet, where we have a double buy. Again, another very near strong buy from Wall Street, a hold from Quant in the midpoint to the upper end of the 52-week range, with a yield of 0.48% and a forward P of around 21.7. This is still the cheapest valued Mag 7 company in the market, and over the last year is up 27%. Over the last 10 years, another significant outperform of the S&P, up 470. They've also beaten analyst targets over the last 4 quarters, and moving forwards, 3 of the next 4 double-digit growth, with essentially the EPS estimate of December 2025 of 8.68, bringing the forward P down to around 19.1. Now, dividend safety is something that is fairly new, so it does sit at 80, but again, something we can consider over the next few quarters and over the next few years. And in terms of the key metrics, well, the recession sales they had plus 8.4%. So let's take a look at dividend yield theory. Now, not one we will focus on in terms of using this model, just given how new it is, but what we do note here is the forward P of 20.8 is lower than their 5-year average of 23.4, although we do see it sit higher than the communications of 12.1. But again, the majority of companies in this bracket are nowhere near as high quality as Alphabet. Now, in terms of the free cash flow payout, well, over the last 12 months at 4%, over the next 12 at 12%, does give us faith that they will increase these dividends at a double-digit rate. And free cash flow, we love to see this. Really good growth over the last 10 years, more than 5 times. And over the next 12 months, this upward trajectory is anticipated to continue. In terms of sales growth, well, nearly double-digit every single year, 9% in 2023, 13% on a trailing 12-month basis. And from a numerical standpoint, we do in fact note very, very good. In fact, more than quadrupled over the last 10. And whilst we have seen both share issuances and share buybacks, from 2018 they have started to do those share buybacks, always a good sign, and hopefully it can continue moving forwards. In terms of the ROIC, very nice to note, not only above 10%, but increasing over longer term. In fact, in the last 3 years at the upper 20% point as well, 31% on a trailing 12-month basis. Definitely one of our favorite metrics to analyze for companies. And in terms of margins, very healthy, above the minimums, operating efficiency, and free cash flow, no cause for concern, well above 5% every single year. Finally, net debt to EBITDA does not get better than this, a true role model for this metric, 0 across the board. For Alphabet, it wouldn't even take them 1 day to pay off all of their debt net of cash on hand. Now, our intrinsic value of $188, how we got this, where we ran it through the DCF model, and the 3 rates for this company were 10, 15, and 20. Now, look, the average over the last 10 years is 24%. The more recent increase was 16. We have gone for the utmost conservative point at 10%. With that discount rate, we in fact get that intrinsic value of 188, giving us upside of 14%. As we said, you can always grab a copy of this model to play around with the numbers. Again, it doesn't have to be just for Alphabet, it can be for other companies. And we do know that Wall Street have upside of 24%. Now, based on our very conservative estimates and judgments, at the 10% margin of safety up to $169, this does look to be a very strong buy. So 10% MOS, remember that is based on a growth rate of 10% moving forwards. And we do also note some very healthy upside from Wall Street in what is essentially the cheapest valued Mag 7 company. For those that want to hit 15%, well, that would be a buy at $160, which to me does strike a very strong buy. Definitely one to consider, especially if you don't have exposure through ETFs like the S&P 500. As always though, do give us your thoughts in the comments below. If you enjoyed today's episode, smash that like button, hit that subscribe and bell button. Don't forget to sign up to the free weekly newsletter below, and also come and join us on the Patreon if you do want to discuss our weekly buys and sells. As always, have a great day, and we'll see you all on the next one.